Lululemon Athletica, the premium yoga and athletic apparel brand. Overall verdict: yellow. Watch. Lululemon was founded in 1998 in Vancouver, Canada. It created the yoga-wear category and turned athletic apparel into a lifestyle brand. Today it operates 677 stores globally, split roughly 55% Americas and 45% international. Women's bottoms, the Align leggings at $98 to $128, are the franchise product. They hold a real premium over Nike by $80 to $100. Fiscal 2026 brought the first revenue deceleration in 5 years. Revenue grew only 4.8%, gross margin compressed 260 basis points, and earnings per share declined 9.5% to $13.27. That deceleration, cyclical or structural, is the central investment question. Price versus intrinsic value. Current price, $118.43. DCF base case, approximately $116 per share. You are paying within 2% of what the model says it is worth. Cash return, 7% on free cash flow divided by enterprise value, versus 4.3 treasury, a spread of 2.7 points. Below the 8 to 10% threshold appropriate for a narrow-moat consumer brand. Bull case, 165 to 175, if gross margins recover and international sustains growth. Bear case, 83 to 85, if the margin compression is structural. Margin of safety entry with 20% discount, approximately 93. The stock is fair value on a base case. The asymmetry favors the bull if margins recover. 4 numbers define Lululemon. ROIC, 22.7% in fiscal 2026, after 7 consecutive years between 17 and 29%. Revenue CAGR, 18.6% over 7 years. Gross margin, 56.6%, 10 to 15 points above Nike. Free cash flow, $920 million. Shares outstanding reduced 10% in 7 years via buybacks. The brand pricing power is confirmed by the numbers. Phase 1 forensic screen, 4 signals triggered out of 8. 3 trace to a single event, the Mirror acquisition cycle. Mirror drove the 2023 asset impairment. The capex spiked to 2.2 times D under that year, and the FCF to net income trough of 0.39. 1 event, 3 accounting reflections, not 3 separate problems. The 4th signal is the 2026 gross margin compression, 260 basis points, the largest single-year move in 7 years. This is the standalone flag. It has no single event explanation. Days sales outstanding jumped from 10 to 18 days in 2026, but the OCF to NI ratio of 1.01 cleared the DSO flag. Forensics watch clean statements, 1 genuine open question. Phase 2 financial analysis. Revenue, $3.98 billion in fiscal 2020, $11.1 billion in 2026, 18.6% compounded annually, remarkable for an apparel brand. China was the primary accelerant from 2022 to 2025. Post-COVID opening drove 40+% international revenue growth. Fiscal 2026, revenue grew 4.8%. Americas softened, China growth decelerated, the power of 3x2 strategy. Delivered on digital and international, but the Americas chapter may be written. Gross margin tells the brand story more clearly than anything else. 55.9% in 2020, peaked at 59.2% in 2025, compressed to 56.6% in 2026. That 260 basis point decline is the moat canary. If Alo Yoga is taking share, the promotional pressure shows up here first. Operating margin, 23.7% at peak in 2025, 19.9% in 2026, a 380 basis point fall. Watch gross margin in the first 2 quarters of fiscal 2027. DuPont decomposition, ROE from 33 to 42 to 32%. The 2026 ROE decline is single lever. Net margin fell 290 basis points. Asset turnover declined only modestly. Leverage held flat. Per Dorsey's DuPont diagnostic, single lever margin deterioration equals pricing or cost pressure, not structural asset impairment. This is the cyclical interpretation. ROIC 17 to 29 across 7 years, 22.7 in 2026. Even the trough is more than twice the 10% WACC threshold. Phase 3 moat assessment. 7 of 9 filters pass. Verdict narrow moat. 1 confirmed competitive advantage. Branding with hysteresis. 20 years of educator community investment created brand association that allows Lululemon to charge $80 to $100 above functional equivalents. Gross margins 55 to 59% for 7 consecutive years, versus Nike at 44 and Under Armour at 45 on comparable products. That gap is the financial proof of brand pricing power. Why narrow and not wide? Alo Yoga is achieving similar gross margins at similar prices. The premium is real but not exclusive to Lululemon. The FY2026 gross margin compression is the first evidence that competitive pressure is working. Narrow moat under active attack. Phase 4 capital allocation. Verdict yellow. Share count 131.8 million in 2020. 118.7 today, 10% reduction via buybacks. The timing is mixed. Fiscal 2022, 810 million at EV to FCF of 43 times expensive. Fiscal 2026, 1.18 billion at EV to FCF of 14 times excellent. The recent buybacks at compressed multiples are the best signal in 7 years. The failure mirror 500 million in 2020. Written off to 443 million in 2023. 100% capital destruction. Textbook institutional imperative. Debt discipline is excellent. D/E never above 0.3. Phase 5 competitive dynamics. Lululemon is in the stability stage. 27 years old, global brand established. 1 active power from the 7. Branding with hysteresis. The specific structural threat is Alo Yoga. Private company, reportedly growing 30 to 40% annually, at Lululemon's exact price points, on the same demographic, with a lower cost influencer model versus Lululemon's educator infrastructure. Lululemon cannot adopt the Alo model without destroying the educator identity. That generates its brand hysteresis. This is Helmer's history's slave trap. International growth, China and EMEA, is the path where the moat is sufficient. Become the globally dominant premium brand, even as America's competition intensifies. Overall verdict yellow. Watch. Lululemon is a genuine narrow moat business at a depressed valuation. The 7-year ROIC record, 17 to 29%, is unambiguous evidence of real competitive advantage. Revenue grew nearly 3 times. Gross margins held above 55% throughout. Shares outstanding fell 10%. And the balance sheet remained clean across the entire growth phase. But fiscal 2026 introduced the first genuine moat signal. Gross margin compression that has no single event explanation. At PE 8.9 and PS 1.2, the market is pricing structural decline. If it's cyclical, America's normalization, leadership transition hangover. Intrinsic value is 165 to 175. The trigger to increase conviction. Gross margin stabilization above 57%. In fiscal 2027 first half. 10-minute quality test, 9 filters. Profitable positive OCF, pass all 7 years. ROE above 10%, pass, range 23 to 42%. Consistent EPS, yellow 3 step-downs in 7 years both traced to single events. Balance sheet, pass D/E 0.3 throughout. Free cash flow, pass positive all 7 years 4.1 to 17% of sales. Low charges, Yellow mirror impairment 2023 plus COVID charge 2020. Share count past 10% reduction in 7 years. 7 of 9 pass, Lululemon qualifies. Shares 131.8 million in 2020. 118.7 in 2026, 10% reduction. Fiscal 2025, 1.64 billion in buybacks at EV/FCF 32 times. Fiscal 2026, 1.18 billion at EV/FCF 14 times. Better timing at the bottom than at the top. 7-year cumulative FCF, approximately 8.6 billion. Total buybacks, 4.86 billion, 56% of FCF. No dividends, appropriate for a growth company throughout this period. Remaining capital, mirror write-off, China store capex, balance sheet cash. Recent FY2026 buybacks at trough are the best allocation signal. Long-term debt, 1.5 billion in 2026. Cash, 1.81 billion. Net cash position of 310 million. D/E, 0.3 throughout the entire 7-year growth phase. TIE estimated at 30 to 43 times annually. Conservative balance sheet, maintained through aggressive store expansion. 3 valuation methods. Cash return, 7% versus 4.3 treasury, modestly above spread. PE 8.9, versus historical range 28 to 74 times. Represents an 80% multiple compression from the peak. DCF base case, 11% discount, 6% growth years 4 to 10. Implies 116 per share. Stock is at fair value on base case. Bull at 8% growth, 11% discount, 165 to 170. Buy with conviction if gross margin stabilizes above 57%.